Your bank account may be quietly rewriting your tax return while you sleep. In 2026, a retiree can do everything that looks responsible: avoid speculation, keep cash insured, chase a better savings rate, and still walk straight into a hidden income trap. The danger is not that the bank fails. The danger is that the interest inside that safe account can trigger taxes on Social Security, reduce your Medicare headroom, and turn a promotional yield into a much smaller real return than the number printed on the bank's flyer. Most retirees are trained to ask one simple question: which account pays the highest rate? But after retirement, that is no longer the only question. The better question is, what does this interest do to every other number in my financial life? Bank interest is not isolated. It flows into your tax return as ordinary income. That ordinary income can change how much of your Social Security is taxable. It can increase your modified adjusted gross income. It can move you closer to Medicare's IRMAA brackets. And none of those consequences are printed in large letters beside the advertised APY. This is not personal tax, legal, or investment advice. It is an educational framework you can use to have a smarter conversation with a qualified CPA or fee-only fiduciary advisor. Do not move large amounts of money, buy a product, sell an investment, or change your retirement strategy based only on one video. But do not ignore the issue either, because the bank is not required to explain how its interest payments affect your Social Security taxation, your Medicare premiums, or your year-end tax bill. Consider a 72-year-old retired professional who is careful, conservative, and proud of never taking unnecessary risks. She receives $22,800 a year from Social Security, $18,000 from a small pension, and $2,400 in annual dividends from an inherited fund. She also has $340,000 in a traditional IRA and $215,000 sitting in a high-yield savings account earning 4.8%. She moved the money after receiving a bank promotion, promising many times more interest than her old savings account. On the surface, that looked like a smart decision. The old account paid almost nothing. The new account produced real income. At 4.8%, a $215,000 balance generates $10,320 of annual interest. That feels like a victory, especially for someone who remembers when savings accounts paid almost nothing. But that $10,320 does not stay quietly inside the account. The bank reports it on Form 1099-INT. It appears on the federal tax return as taxable ordinary income. It is not long-term capital gain income. It is not qualified dividend income. It does not receive special treatment simply because the money was safe. It is added to the rest of the retiree's income and taxed according to the rules that apply. The first hidden mechanism is Social Security provisional income. The IRS uses provisional income to determine how much of your Social Security benefit becomes taxable. The simplified formula is adjusted gross income plus tax-exempt interest plus 1/2 of your annual Social Security benefit. For single filers, the key thresholds are $25,000 and $34,000. For married couples filing jointly, the key thresholds are $32,000 and $44,000. Below the lower threshold, Social Security may not be federally taxable. Between the thresholds, part of it can become taxable. Above the upper threshold, the formula can cause up to 85% of benefits to be taxable. Before the high-yield account, this retiree had $18,000 from her pension and $2,400 from dividends. That is $20,400 of non-Social Security income. Half of her $22,800 Social Security benefit is $11,400. Add those together, and her provisional income baseline is $31,800. She is above the lower single filer threshold, but still below the upper threshold of $34,000. Under the actual formula, that does not automatically mean half of her entire Social Security check is taxed. It means the taxable portion phases in. In this example, roughly $3,400 of her Social Security would be included in taxable income. Now add the bank interest. Her non-Social Security income becomes $18,000 from the pension, $2,400 from dividends, and $10,320 from interest. That totals $30,720. Add half of her Social Security benefit, and her provisional income jumps to $42,120. She has crossed the upper threshold. Now the formula pulls much more of her Social Security into taxable income. Her taxable Social Security rises from roughly $3,400 to about $11,400. That means the bank interest did not just create $10,320 of taxable interest. It also caused about $8,000 more of her Social Security to become taxable. This is the part retirees often miss. The bank statement shows $10,320 of interest. The tax return shows something much larger happening. If her combined federal and state marginal tax rate is about 26%, the direct tax on the interest may be around $2,700. The extra tax created by the additional taxable Social Security may be around $2,100. Together, the tax cost connected to that high-yield account could be close to $4,800. So the retiree may think she earned $10,320, but after the tax interaction, her usable benefit may be closer to $5,500. That does not mean high-yield savings accounts are always bad. It means the advertised rate is not the real rate. A 4.8% account may still be better than a 0.4% account, but it may not be nearly as good as it looks. And once you are retired, the real question is not just gross interest. The real question is after tax, after Social Security, after Medicare impact. A working person can often chase the highest safe rate and move on. A retiree has to ask whether that rate is changing the rest of the retirement income picture. The second hidden mechanism is Medicare IRMAA, the income-related monthly adjustment amount. Medicare generally uses modified adjusted gross income from a prior tax return, often with a 2-year look-back, to determine whether higher-income beneficiaries pay extra for Part B and Part D. That means income earned in 2026 can affect future Medicare premiums. The exact brackets change, so retirees should check the current official table for their filing status. But the concept is simple. Recurring interest income fills up the space under those brackets every year, even before required distributions. Roth conversions, capital gains, or one-time withdrawals are added. This is where a traditional IRA becomes important. If the retiree has $340,000 in a traditional IRA, required minimum distributions may begin soon, depending on her age and the current rules. A first required distribution could easily be in the range of $12,000 to $13,000, depending on the year-end balance and IRS life expectancy factor. That RMD is ordinary income. Add it to pension income, dividends, bank interest, and taxable Social Security, and suddenly modified adjusted gross income is much higher than it looked when she first opened the savings account. The interest becomes background noise that never turns off. Even if she is safely below an IRMAA bracket today, she may not stay there. One year she might sell an appreciated investment. Another year she might take extra IRA money to repair a roof. Another year she might do a Roth conversion. Another year she might receive taxable income from property or a business sale. In each of those years, the savings interest is already sitting at the bottom of the calculation, reducing her flexibility. It may not be the single reason she crosses a Medicare bracket, but it can be the extra weight that pushes her over the line. There is also a separate bank reporting issue retirees should understand without panicking. Under the Bank Secrecy Act, banks file a currency transaction report for cash transactions over $10,000 in a business day. This applies to physical cash. It is not the same as ordinary electronic transfers, direct deposits, checks, or wires between accounts. A currency transaction report is not an accusation, and it does not mean anyone did anything wrong. It is routine compliance. The real danger is structuring, which means deliberately breaking transactions into smaller amounts to avoid the reporting threshold. For example, a retiree sells a property and later withdraws a large amount of cash to help a family member. If the withdrawal is over $10,000, the bank files the report. That is normal. The problem begins when someone says, "Take out $9,500 instead so nobody reports it." That advice can create legal trouble. Choosing transaction amounts specifically to avoid reporting can be treated as structuring. Even if the underlying money is completely legitimate, the safest habit is simple. Never choose a cash amount because it is just under a reporting limit. Use the amount you actually need, keep documentation, and use traceable payment methods when practical. The reason retirees need to hear this is that retirement often comes with large life events. Homes are sold, businesses are closed, inheritances arrive, adult children need help, medical bills appear. A person who never handled large transactions before may suddenly move meaningful money. That is when casual advice from a neighbor or relative can become dangerous. Compliance is not something to fear when your money is legitimate. But intentionally trying to work around reporting rules is not a retirement strategy. It is a mistake that can create unnecessary stress. Now ask yourself who is responsible for connecting all these dots. The bank's job is to attract deposits and pay the rate it advertised. The tax return's job is to report the income. Medicare's job is to apply its premium rules. Social Security taxation follows its own formula. No single institution is required to look at your full life and say, "This interest may reduce your net retirement outcome." That responsibility falls on you and the professionals you hire. The bank may be honest, safe, insured, and professional, but its promotional rate is not a financial plan. So how do you find your own danger line? Start by writing down your annual income before bank interest. Include pension income, part-time work, rental income, taxable dividends, IRA withdrawals, required minimum distributions, and any other recurring income. Do not include your full Social Security benefit in that first number. Then write down 1/2 of your annual Social Security benefit. Add the two numbers together. That is your provisional income baseline before counting savings interest. This one number tells you how close you already are to the Social Security taxation thresholds. If you are single, compare your baseline with $25,000 and $34,000. If you are married filing jointly, compare it with $32,000 and $44,000. If your baseline is below the next threshold, the difference is your headroom. If a single retiree has provisional income of $31,800 before savings interest, the distance to the upper threshold is $2,200. At a 4.8% interest rate, $2,200 of interest is produced by about $45,800 of savings. That means roughly $45,800 is the balance that would fill the remaining Social Security headroom at that rate. In the example, the retiree has $215,000 in the account. If about $45,800 fills the remaining threshold space, then around $169,000 deserves a serious review. That does not mean it must all be moved tomorrow. It does not mean it is illegal, foolish, or unsafe. It means the excess balance is producing taxable ordinary interest that may be affecting other parts of the retirement plan. Once you identify that number, you can stop guessing and start planning. If you are already above the upper Social Security threshold, the analysis changes. At that point, additional interest may not create the same Social Security surprise because much of the formula has already been triggered. But it can still increase ordinary income tax, push you toward a higher federal bracket, reduce your Medicare IRMAA headroom, and limit your ability to do other planning moves. The goal is not to obsess over one threshold. The goal is to understand how much recurring income your cash is creating and whether that income is worth the cost. Before reallocating anything, protect liquidity. Every retiree needs accessible money for bills, emergencies, insurance deductibles, home repairs, taxes, and peace of mind. The answer is not to empty every bank account and create anxiety. The answer is to separate true emergency cash from excess cash. Some households may want 6 months of expenses available. Others may want 1 or 2 years. The right number depends on health, income stability, home ownership, family support, and comfort level. But money beyond that true liquidity need should have a job, not just a promotional rate. One possible use for excess cash is to support a planned Roth conversion strategy. If a retiree has traditional IRA money that will eventually be taxed through required distributions, cash outside the IRA can sometimes be used to pay the tax on carefully sized Roth conversions. The goal is not to convert everything at once. The goal is to manage tax brackets over several years, reduce future RMD pressure, and create more tax-free flexibility later. This must be modeled carefully because a conversion itself increases income in the year it happens and can affect Medicare premiums. Municipal bonds may also be worth discussing with a qualified advisor, especially for retirees in higher tax brackets. But they are not magic. Tax-exempt interest may avoid regular federal income tax and sometimes state tax, but it can still count in the provisional income formula for Social Security and may still affect Medicare modified adjusted gross income. Treasury bills, CDs, and money market funds may be safe, but their interest is generally taxable federally. Series 1 savings bonds can defer federal tax until redemption, but purchase limits and changing rates matter. Every tool has a trade-off. Some retirees may consider tax-deferred fixed annuities or multi-year guaranteed annuities for a portion of conservative money, because interest can accumulate without a yearly 1099 until withdrawals begin. But these products have important limits, including surrender charges, liquidity restrictions, insurer risk, taxation when funds are withdrawn, and contract details that must be understood before signing. For some people, they can help control timing. For others, they are the wrong fit. The point is not to chase a product. The point is to ask whether you can control when income appears instead of letting bank interest appear automatically every year. The most important planning question is this: when should income show up? Bank interest gives you very little control. It is earned, reported, and taxed each year. Traditional IRA income is taxable when distributed and eventually forced out through RMDs. Roth money may provide tax-free qualified withdrawals. Taxable investments may create dividends and capital gains, but some gains can be timed. Deferred products may postpone income but reduce flexibility. A strong retirement plan does not look at each account separately. It coordinates timing, taxes, liquidity, risk, and Medicare impact together. Your action step this week is simple. Log into every bank account and find your year-to-date interest earned. If you cannot find it, call the bank and ask. Write down the number. Then write down your pension, Social Security, dividends, IRA withdrawals, rental income, and any expected year-end income. Calculate your provisional income. Check your room under the Social Security thresholds. Then check your estimated modified adjusted gross income against the Medicare brackets for your filing status. If the numbers are close, schedule a tax planning meeting before the year ends. When you meet with a professional, do not ask only, "Is this account safe?" Ask, "What is my after-tax return after Social Security taxation and possible Medicare effects?" Ask, "How much cash do I truly need liquid?" Ask, "What balance can stay in interest-bearing accounts without disrupting the rest of the plan?" Ask, "Would Roth conversions, different bond choices, tax-efficient investments, or deferred income tools improve the long-term picture?" These questions turn a bank product into a retirement strategy. The larger lesson is that retirement money is connected. A savings account affects a tax return affects Medicare. An IRA affects Social Security taxation. A Roth conversion affects future RMDs. A home sale can affect premiums later. If you manage each account in isolation, you may miss the chain reaction. The money that looks safest can still create tax drag. The account with the highest rate can still produce a lower real result. And the financial institution advertising the rate may never be the one that explains the consequence. This matters even more because the Social Security taxation thresholds have not kept pace with inflation. The amounts that once affected a smaller group of retirees now reach ordinary households with modest pensions, small investment accounts, and careful savings habits. You do not have to feel wealthy to be taxed like someone with significant income. That is why a routine bank decision in 2026 can matter so much. You are not wrong for wanting safety. You are not wrong for holding cash. But safety must be measured after the rules are applied, not before. Do not panic. And do not rush into a new product because someone made interest sound dangerous. Panic is not planning. Instead, collect the numbers, run the calculation, protect your emergency fund, identify the excess. Then decide, with qualified help, whether that excess belongs in a different structure, a different account, or a different tax strategy. The goal is not to avoid interest completely. The goal is to make sure every dollar of interest earns its place after taxes, after Medicare considerations, and after its impact on Social Security. If this information helped, like the video, subscribe, and share it with one retiree who keeps a large balance at the bank and has never run this calculation. Not to scare them, but to give them the question they may not know to ask. How much interest can I receive before it changes the rest of my retirement income? That one question can prevent surprises, improve tax planning, and protect retirement cash flow. The bank can tell you the rate. Your tax return shows the consequence. Your job is to connect the two before the calendar closes. USA Retirement Guide.